Welcome back to the channel. A lot to unpack this week. A lot to talk about with the Bank of Canada now cutting an additional 0.25% earlier this week. That is now 2 consecutive rate cuts from the Bank of Canada, bringing that overnight lending rate down to 4.5%. Now, this week we'll talk about what that means if you have a variable rate mortgage and ultimately what things you should be considering if you're planning on taking on a variable rate mortgage. But more importantly, I want to unpack the probability of another rate cut in September, talk a little bit about the economic conditions based on what the Bank of Canada is looking at and what data we need to see or what data needs to continue rolling out in order for that to sort of happen. So we welcome you to the channel. If you have not subscribed, please go ahead and do so. Don't forget to hit that notification bell. Most importantly, let us know your thoughts and questions in the comments section below. We want to hear from you. Now, before we get into the Bank of Canada sort of outlook, the surveys, and sort of our opinions on what we think will happen in September, I think it's important to understand that as a Canadian with a variable rate mortgage, if you're looking at this additional 0.25% discount, well, what does it sort of mean for you? And every $100,000 mortgage based on the current variable rate, prime lender with most of the major banks, we started at 7.2, came down to 6.95, and now we're sitting at 6.70. So if you were to have a variable rate mortgage with, let's say, a discount of prime minus 1%, prime being where we are now, obviously 6.70% minus 1, you might be sitting at 5.70%. And that equates to around about a $15 change per 100,000. So right now, if we were to tally up the last 2 consecutive rate cuts, providing that your mortgage is at a discount of 1%, well, you're probably looking at around a $30 discount per 100,000. Now that may not sound like a lot, but if you're carrying a larger balance, it does have a little bit of play. It does help you a little bit. And obviously that's not going to move the needle for a lot of Canadians. But what's important to understand is you may not have seen some of these changes to your variable rate mortgage, especially if you have a static trigger rate type of mortgage where that payment remains the same. What happens in these cases with these types of mortgages is that more of that money goes towards the principal than it would be towards interest. So you might be seeing that discount happening in a different way. If you have an adjustable rate, a true adjustable rate mortgage, well, then you would have seen your payments actually change. You would have got a notice from your lender. And ultimately, the conversation around having a variable rate mortgage is becoming a little bit more popular now, as many Canadians now will see that the Bank of Canada is potentially on this trajectory to cutting rates, and a lot of people want to be along for the ride, but making sure you're selecting the right variable, making sure that you're getting the best options. Obviously, you want to talk to a mortgage professional, get the right advice, and see what different lenders are offering you so that you can make sure to keep more money in your pocket. Now, ultimately, there's a lot of other pros and cons when it comes to taking on a variable, and obviously it comes down to your appetite for risk, especially being able to budget accordingly, and obviously looking at that disparity between what a current rate fixed mortgage and what a variable rate mortgage looks like and those payments. Let's roll into the Bank of Canada conversation, and ultimately with the press conference this week, obviously the monetary policy report that's being released for this quarter, as well as the business and consumer outlook survey. The Bank of Canada is providing us with a lot of data, a lot of insight, basically what they're looking at when making their decision about what to do with monetary policy. And they've decided at this particular meeting this week that they're going to cut a 0.25%. And ultimately what will happen in September if we continue to see this negative data coming out of the Canadian economy, the Canadian consumer, obviously the Canadian businesses, and obviously geopolitical, obviously what's happening in the US. So a lot of push and pull factors is what the governor of the Bank of Canada is really looking at. They are going to be data dependent. They are going to take it each and every step, each and every meeting. They're going to decide. There's really not much guidance, but they did say that it is reasonable to expect that if their data aligns broadly with their expectations, right, meaning that if they see what they want to see, well, we could definitely see some more rate cuts down the pipeline, as they do believe that the Canadian economy, the current policy rate, is in restrictive territory. So that meaning it's still a little high and it's not really going to open up the door for a lot of opportunities, especially when it comes to business investment and consumer sentiment, so on and so forth. So ultimately, the Bank of Canada is alluding to the fact that global inflation is pulling back. They expect it to be at 2% by the second half of 2025. Obviously, there's a forecast. Looking at that data, ultimately, they do understand that there's going to be these peaks and valleys that we've talked about extensively on the channel. But also extensively on the channel, we've talked about the Canadian economy and the fact that the Bank of Canada is cutting rates not to salvage the housing market or the Canadian mortgage holder. There are unintended consequences when the Bank of Canada cuts rates, but the major reason that the Bank of Canada is cutting rates is not to bail out homeowners. We can argue that, but ultimately because of the Canadian economy. The fact that the Bank of Canada cannot specifically target individual segments of the economy, the market. It cannot target just business owners and just homeowners and just those with this income and that income. It's sort of doing a monetary policy. It's making its decision for the broader economy. That's the idea with inflation, why they want to target inflation to bring it back down to 2%, because inflation targets everyone, where mortgages and homeownership only target a limited amount. Now, what they pointed to is that is obviously the fiscal responsibility of the elected government. The elected government can make decisions for specific segments of individuals, whether it be business owners, new to Canada, so on and so forth. They have the ability to target specific groups where the Bank of Canada does not. Monetary policy, as I mentioned, blanket. Fiscal policy, which is the government, elected government policies and legislation, very specific. And the reason behind that is, well, we have this conversation around immigration. And literally one of the comments, one of the questions that were put forward to the Bank of Canada governor was around the fact that if we did not see this higher level of immigration in 2023, where would the Canadian economy be? And this is something that you may recall we talked about in a previous episode or in multiple episodes. And I've been arguing saying, look, if we didn't have these higher levels of immigration, maybe the Bank of Canada would have to cut a lot sooner because the Canadian economy would have been showing those signals. A long time ago, we would have saw the breaks, the cracks in the Canadian economy, but we sort of inflated and skewed those numbers by bringing in new to Canada individuals. Now, I don't want to mistake this conversation for anti-immigration. I am pro-immigration. Once again, we come from a family of immigrants that came to this country for a better life. And ultimately, we need new Canadian blood to replace the aging population for labor and workforce participation. We need more tax revenue. We need more people. We need the right people. We need skilled trades. We need doctors, nurses, everyone that can contribute to the economy to help basically improve the economic productivity of Canada. I mean, it goes without saying, we definitely are, many Canadians are feeling these pressures, right? They're opting not to have children or putting or delaying starting a family because of the higher cost of having a family. So with that, I mean, immigration is an easy way to boost that population number. But with that population increase comes obviously an unintended consequence. So literally, that's one conversation. We've talked about it on the channel before. I don't want to flog this dead horse by having it again, but you have to look at the Canadian economy as a whole. What's happening with GDP? What's happening with growth? I mean, their forecast is that it's going to come back online by some point in 2025 or 2026, right? Inflation is going to be back down to 2% by second half of 2025. But ultimately, the consumer sentiment, the consumer pullback is a huge problem for the Bank of Canada. And whether you're looking at the Outlook survey for consumers or the monetary report, we'll put those links in the description box below so you can take a look for yourself. But ultimately, it's not really a telling sign of a predominantly robust economy. If you have consumers that are facing obviously higher mortgage interest costs, rents, food inflation, goods and service inflation, ultimately, yes, inflation is pulling back. The rate of change arguably is reducing. So we're not going to see things get expensive, but we're not going to see them come back to pre-pandemic levels potentially, right? So they are not going to increase. A lot of Canadians still feeling those pressures. And as Canadians begin to prepare, not only for the fact that, hey, if I have a mortgage, it's going to be renewing in the next little while. I got to be prepared for a payment shock. I'm going to be prepared for that renewal, especially if you got a mortgage in 2020 and it's renewing in 2025. Unless something significantly happens where interest rates pull back, you can almost put your hands on the fire. And I'll say that you're going to be paying a little bit more than you were previously from those rates back in 2020. So even if it's a couple $100 or depending on the size of your mortgage, a lot of Canadians that are in the paycheck to paycheck, lower income percentile, maybe they're paying rent, maybe they have a small mortgage, maybe they're retired. They're going to have to budget accordingly for that additional cost. And that means the money that would have additionally been left over for disposable income or for leisure activities, for savings, is not going to get, deployed back into the economy. And if you extrapolate that into larger scales, the Bank of Canada is starting to see that. And remember, a lot of the data that the Bank of Canada is compiling is always a backwards looking. It's always got a lag. So we don't have many leading indicators, things that are sort of telling us where the future of the Canadian economy is going. One of those things is obviously looking at mortgage renewals, right? Seeing the fact that, hey, interest rates are this far apart, average mortgage is this size, that's how much money it's going to cost the average Canadian. And as I said, if you want to take a look at those options and see what you should be prepared for or what to budget, even if you're planning to buy or get pre-approval, in the description box below, there is a link to our free app. You can run some of those numbers for yourself. But ultimately, the Canadian consumer is a big component of the Canadian economy. And with that, businesses get impacted by the fact that Canadian consumers may be pulling back. One person's spending, right, and income is another person's income. So, you make money, you go out and you buy something from another business, that is someone else's income. And if I'm not spending the money, that business is not making the money. And as that continues to play out, as interest rates stay elevated, we're sort of feeling that pressure from those higher interest rates, and businesses are not going to be hiring. They're not going to be investing in new machinery or, productive measures to make things better, because it takes money, it takes capital, development in new programs or new businesses or new ventures, not going to happen when the economy is slowing down. It's receding, right? And that is literally what the Bank of Canada is sort of pointing to. They want to have this soft landing. They want to pull off this miracle by making sure that we get inflation back down to 2% while still maintaining a relatively positive unemployment level. And that has ticked up over the last little while. And, between now and the next time the Bank of Canada meets, which will be in September, as I mentioned, there could be a lot of damage, right? There could be a lot of negative data. And because the Bank of Canada is going to have to wait 8 weeks, while they want to make sure that they are going to be reactionary, right? And they want to be proactive, not reactive. So they want to make sure that they're making these adjustments when the economy still has the ability to absorb the changes, rather than, the economy flatlines and they're having to basically defibrillate it by dropping interest rates hard and fast like they did when they raised them hard and fast back in 2021. And arguably, this is sort of where the Bank of Canada, what I'm sort of reading between the lines, is that the Bank of Canada has realized, right, that, hey, we made a mistake. We should have started to raise interest rates back in 2021 when we started to see inflation tick back up. And then we had to scurry and quickly, within 18 months, go from pretty much 0.25 to 5% in 18 months to sort of, cool the economy down, cool inflation down. And now they don't want to make that mistake on the way down, because they could restoke, reignite, and obviously the housing market. And ultimately, as I said, for Canadians looking at this cut from the housing perspective, I don't necessarily know if it's going to be an instantaneous reaction. As I've mentioned, and I'll stand by it, I don't think 0.25% is going to move the needle for a lot of Canadians, especially with the economic uncertainty surrounding employment. Obviously, those that have secure jobs, have the ability to earn a very good income, have the down payment, they're going to be at a position that is much different than someone else who's maybe starting out. Right now, what we've been noticing, a lot of buyers are making that move upwards if they can qualify. A couple of buyers looking at the market right now. Things are still unaffordable in many of the major hot pockets within Canada. And this is a big deterrent as interest rates are still high. We need to see how this game really plays out, and really how much more the Bank of Canada is going to cut before we start to see this big floodgate open with buyers. And if we will even see that, is let's say the Bank of Canada does reduce interest rates. I mean, to what point? At what point is that going to open up the door? I mean, we're definitely not going to see what we saw back in 2021 with those types of interest rates leading into 2022. I don't think we're going to get to that point. But at what point is it going to be more balanced, more equitable for buyers, right? That little bit of a balance. And what's going to happen with home prices? Ultimately, it's anybody's guess what's going to happen right now. But as we see more inventory come to the market, we start to see a little bit more homes being listed. As many Canadians might be looking to sell, many Canadians might be looking to relocate, transfer to a different province, maybe downsize as they're retiring. A lot of questions, but as the Bank of Canada looks at all this data, I really think that the Canadian economy is center focused. I think that's what I'm going to argue, is that housing, mortgages, one component. The Canadian economy is the reason why the Bank of Canada cut. And I think we will continue to see cuts in the future months ahead as we start to see pullback in developments, in construction, in real estate, I mean, that is literally a knock-on effect. If we start to see jobs being, reduced, see less people working, construction projects, which are, construction, real estate, arguably 9%, they say 9% of GDP. Obviously, the knock effect is even greater. We start to see that happen. Ultimately, where does this equilibrium happen between more homes, what price, less homes, what price? What is going to be that balancing for builders to come back to the market and start building more homes? That's literally the question. But right now, I think good news, Bank of Canada cut 50 basis points. We have an additional potential cut coming in September if the data aligns broadly with what the Bank of Canada expects, and potentially more. The last thing I want to say is that the US is ultimately a big player in this, even though Canada has its own monetary policy, its own currency, its own needs and wants. Bank of Canada is looking at the Canadians and the Canadian economy independently. There is a divergence right now slightly as we continue to lower ahead of the US, but that might change in the next little while as the US has basically talked about potential cuts on the table, even as early as the month of July, and eventually a very big probability for September as their labor market continues to weaken, their consumer sentiment continues to pull back, as well as their inflation levels continue to normalize and pull back. There could be that conversation, which will bridge the gap between the Canadian and the US policy rate, the Fed's fund rate. And that ultimately is good news for Canada, allows them more cover to maybe cut a little bit more. We'll see exactly what happens in September, but let us know your thoughts and opinions in the comment section below. Will the Bank of Canada cut in September? Was the Bank of Canada right to cut in July? Let me know your thoughts. I want to hear from you. But we'll leave the video here. Wishing everyone a wonderful week and an even better weekend ahead. Thanks for stopping by.